there, everyone. Very good evening, and this is Diksha Janyani representing Team Trendline. And this week we discuss India's biggest IPO, which is of LIC, which opens on May 4 and closes on May 9. LIC is the market leader in the Indian insurance sector and commands 63% market share in the new business premiums earned by the sector for FY22. So the government is actually looking to raise roughly 21,000 crores from the markets by divesting 3.5% stake in this company. The price band fixed for this issue is between 902 to 949. And at the upper price band, the company will command a market capitalization of 6 lakh crore upon listing. Can you beat that? So the government was actually looking to divest 5% stake in LIC so as to fulfill its disinvestment target back in FY22. However, looking at the current geopolitical conditions and market appetite for this offer, it decided to trim the stake sale to only 3.5%. In fact, SEBI made a special exemption in national interest for this company so that it could list on the exchange with less than 5% float. Also, the company will have to file fresh draft red herring prospectus and recalculate its embedded value if it misses the deadline of May 12th. And that is what's the rush for. The company is also seeing good traction from domestic institutional investors and believes that the markets have stabilized in the past month. However, markets do remain choppy, and foreign investors have pulled out a record 1.2 lakh crore from the Indian markets in 2022. That is the reason why analysts are apprehensive on the timing of this issue. So on this note, let's discuss the embedded value determined for LIC. So Milliman Advisors determined an embedded value of 5.4 lakh crore for LIC on September 30th, 2021. In fact, this embedded value jumped 5.5 times in a matter of just 6 months. This is because of key amendments made to the LIC Act. Earlier, LIC just had a single fund which contained of surpluses from its participating and non-participating businesses, which it allocated between the policyholders and shareholders in the ratio of 95:5. However, with the amendments to the Act, it will now have two funds instead of one, each based on its participating and non-participating business. So the allocation ratio for the participating business remains same at 95:5. However, the plan is to increase this to 90:10 by FY25. Also, the shareholders will have 100% claim to the surplus contained in the non-participating fund. And because the profit attributable to the shareholders increased by this exercise, and also the non-participating fund was marked to market, the embedded value of LIC leapfrogged by that much times, basically 5.5 times. So if we further analyze the price to embedded value for LIC, it is 1.11 times currently, and private listed companies back home are valued anywhere between 2.4 to 4.2 times. So considering this, LIC's issue does look attractive. However, the valuation is quite in line with the global peers, and in fact its price to embedded value ratio is close to that of AXA SA also. So to find out whether this deal is a steal for you investors out there, we will analyze 5 key business metrics for LIC and have a little bit of comparison with the private listed companies as well. So number one is the new business premium. So LIC's new business premium for its group segment stagnated at 1.27 lakh crore in FY21. However, the company made a swift recovery in Q4 FY22, which is last quarter of the year, and quite a business time for the insurers out there, and recorded double-digit growth in the group premium segment. However, its individual premium segment witnessed a slight fall by 2 to 3% in FY21 on a year-on-year basis. Also, the company recovered its market share between December 2021 and March 2022, and especially March 2022, which is the closing month of a financial year for India Inc. And also, although it did reclaim 2% of its market share between 9 months ended FY22 and FY22, overall the company has lost 6% market share to its private peers like SBI Life Insurance and HDFC Life Insurance. Now we will find out the sources of this new business premium, basically the distribution channel that LIC employs to earn this premium. So for its individual policy segment, LIC relies heavily on its agency network, which consists of 13.5 lakh agents. So the movement of these agents was hampered in the first and second COVID wave, which is also a key reason why the company witnessed subdued growth for its individual new business premium between FY20 and 22. In fact, the private peers ate up its market share because they had well entrenched digital channels which had a far better reach to their customers than LIC. So number two factor is the gross written premium, which is the principal revenue source for an insurance company. It basically measures the premium earned by the company from the policy which is actually passed on, which is given a go ahead by its underwriters. So LIC did witness a decent growth in its gross written premium between FY19 and FY21, and considering that it reclaimed its market share in the last quarter of the year, it will also end FY22 on a good note as far as this metric is concerned. Number three metric is the persistency ratio, which basically measures how good a insurance company is in retaining its customer base. Basically, measures the customer stickiness, to put it that way. So, LIC's persistency ratio is around 62% in the 61st month of the policy being in force, whereas for the private players, it's below 55% for that month. And in fact, for private peers, they have also seen a sharper fall in this ratio between the 49th month and the 61st month of the policy being in force. So that's one point to note there. Number four point here is the number of individual and group policies issued for a certain period of time. So LIC gained a good 8 percentage point market share in the group policy segment between FY21 and FY22. However, it was on a losing streak as well as the individual policy segment is concerned. But again, it made a comeback and ended FY22 on a status quo. Basically, it could retain its market share in that segment. In fact, its private peers ended up losing share in the last quarter of the financial year 22. So before we move on to the last metric here, we should understand the product portfolio for LIC. So the product portfolio of LIC, 99% of it contains of non-linked schemes, which are basically not linked to any interest rate benchmark or the equity markets. And within this portfolio, 63% of the schemes are participating in nature. Basically, they have a right to claim the profits of the company in form of bonuses or dividend. For private insurers, on the other hand, 69% of their portfolio is non-linked, within which only 29% of the portfolio is participating in insure. And this is the reason why there is a difference between the margins that LIC enjoys and the top private peers enjoy. LIC enjoys low value of new business margin, which is basically the profit margins for a life insurer, which are basically 9%, 9.3%. And whereas for the private peers, the value of new business margins are between 25 to 28%. So that's one factor. However, the LIC is looking to expand its non-participating segment so that it can, boost its profit growth going forward. So the main question here is, should you consider this IPO now? So ideally, the thing I would do is wait here. Why I say that is because LIC did maintain a good growth trajectory in Q4 FY22. In fact, it made a quick comeback and finished the year on a good note as far as the new business premium growth is concerned. However, it is still plagued by its legacy sales distribution system and low margins. So, ideally, one should wait for the company to reclaim its market share, improve its product mix over the next 1 year, and then take the final plunge. So, this was my time, folks. Thank you so very much and have a great day.